You have to look at all your relationships, and you have to be willing to pick up the phone and call them. You have to be willing to pick up the phone and ask people. The money just doesn't walk in the door. But, the call and say, hey, give me your money that you worked hard to earn and trust me that I'm going to do a good job with it. You got to feel good about that. And, the good news is I never lost money in a deal. You do real underwriting and do real assumptions that are believable and achievable. That's my big mantra, and if you do that, things will work out.
This is episode number 10 of the Multifamily Success Stories podcast. Would you like to turn vacant units into cash and earn up to 3 times more per door without having to do any extra work yourself? We offer fully managed short-term rental solutions for multifamily investors. Go to managedbylux.com for more information.
Hey, this is John Bell
and Julian Sage,
and welcome to the Multifamily Success Stories podcast. This is a show where we talk to multifamily investors about their journeys and starting and growing their real estate empires.
Our goal is that you'll be able to walk away not only inspired, but with practical information to help you in your real estate journey.
Since we are a new show, please go over to iTunes and leave us a review and let us know what you enjoy.
And if you haven't done so already, go on over to our Facebook group, the Multifamily Success Network, to connect with the community. Hey, what is going on, deal makers? Julian Sage here again. And in this episode, I have the special honor of speaking with Tim Wallen, CEO of MLG Capital, a 33-year-old investment company that invests into commercial assets around the country. MLG has acquired $2.5 billion in assets, equating to 20,000 multifamily units and over 4 million square feet of commercial space. In this episode, Tim shares his journey of starting out as an accountant and how that played into real estate, how Tim ended up at MLG, what led Tim into the position as CEO, the biggest obstacles MLG faced over the years, and what they've done to pivot their business into the future. It's been really interesting to talk to so many different people in the multifamily space. This is a really exciting episode because we get to find out exactly what it takes to be able to really run something that is at such a large scale. MLG Capital has over 400 employees and 3 different offices in Wisconsin, Texas, and Florida. What was really interesting to hear was that they built up this business for many, many years just doing syndications, and they had a very robust team and system to really do these syndications. But then Tim pivoted MLG into a fund structure. To be able to talk with Tim and be able to find out what it was like, running this large-scale syndication business and then having to pivot that midway into a fund structure. There's a lot of golden information in this episode. So if you'd like my show notes for this episode, go to multifsuccess.com/EP10. Or if you'd like my show notes sent directly to your inbox every week, then go to multifsuccess.com/show notes. With all that being said, on to this week's conversation. Hey, welcome back, deal makers, to another episode of Multifamily Success Stories. In this episode, I have the special honor of speaking with Tim Wallen. Tim, would you please introduce yourself to the deal maker community, let them know who you are and what inspired you to get into multifamily investing?
Sure. Thanks, Julian. Well, I've been doing this real estate thing for 35 years now. I grew up in the CPA world with Pricewaterhouse out in San Francisco. And had many real estate clients. I grew up in Wisconsin, did the rubber band thing, went out to California, and then came back to Wisconsin in 1988. Had MLG as my client for a year, and then I joined him in 1989 as a CFO. So I've been on the pure investment side, buying multifamily investments since 1989. I took over the leadership role in the year 2000, MLG as the CEO in 1999 I became the CEO. But right today, we manage roughly 20,000 apartment units nationwide, done billions and billions of dollars with real estate investing. So it's been a lot of fun.
Definitely. Yeah. I'm excited to find out more about your story. So, one of the things that I, is really I enjoy about this show is going back to when you first got started. So can you take us back to, you went to school to study and become a CPA. Did you plan on getting into like real estate? Was that like your goal? Was like, hey, I want to, eventually own or, eventually manage a fund that's dealing with, $2.5 billion of, of money? Or did you think like, hey, I'm just trying to get a job that will, be able to, pay my bills?
I've always been a bit of an entrepreneur. I had my own landscaping business as a kid, and I had all my snow shoveling jobs and all kind of stuff as a kid, teenager and middle school and all that kind of good stuff. So I've always been a bit of an entrepreneur. But I went into public accounting just because you can learn so much about a variety of businesses, and it gave you the flexibility to really go into a variety of different directions. But once I got into it, it's kind of this life's chances, right? You don't always plan things in life. I got put in the real estate group, and I was a Price Waterhouse in San Francisco. So I wasn't necessarily planning on going into real estate. I kind of got put there as part of a large public accounting firm, but I've never left it. I was there as a rookie out of college, out of grad school, and working with other clients. But when I came back to Wisconsin, I started working at MLG in '89, and living and breathing real estate, and just really like it. It's got unique attributes, and obviously I've been at MLG for 31 years, so there's something keeping me here.
What was that first job like? Did you have to, because what did that entail? Because typically you don't think of, accounting and real estate. Obviously there's a lot of numbers in real estate, but that's not usually the first thing that comes to mind, like an accountant that ends up becoming, a real estate manager.
Well, in real estate, it's a lot of mathematics. There's the visioning what you can do for something. So maybe some financial guys don't necessarily have that vision of what you can do with something. There's a mix of marketing and creation, but ultimately it comes down to the numbers, because if you're not making money, you're not going to be able to buy much or do much if you're not making money for your clients. So the financial skills are very valuable. Just being my tax background, Price Waterhouse, we're very proactive about using all the rules and tools that we can. And I think I save another 1.5% to 2% in after-tax yields to our investors above right on our economic yields, just from great tax planning. And I think beyond what you see even most other real estate guys do, just because I use every tool possible.
Can you talk to us about, like, what was that first job like? Did you know what you were getting yourself into with that, or was it like a completely different world?
If you're talking about my first job at Price Waterhouse, it is a shock going from the la la land of college, and all of a sudden you're now working 60, 70 hours a week as a young kid out of college and trying to make your way. And it's a big change. But you learn it. You just got to, as a young adult, you soak it in, learn as much as you can, make yourself better. If you work hard for others, that'll come back to you and fruit and opportunities that you get. And you make your opportunities, I believe, in life. And working hard and doing a good job for the folks you're working for will help you along in that way. But it was a bit of a shock making that change from college to the working world. But it's skills you have for life.
And what did they have you specifically doing at this first position?
Well, I was on the tax side of Price Waterhouse, and that's also why I ended up in the real estate side, because back in the mid '80s there was a lot of real estate structuring transactions for tax benefits. But do a lot of we did a mix of audit and tax work in the real estate area, and a lot of strategies on how to not pay the government taxes as best you can. But those rules did change in 1986 and changed the way we approached taxation in real estate overall. But lot was learned in that time frame.
So you were dealing with what, clients and their portfolios and trying to help them save on taxes through specifically real estate?
Yeah, that was a chunk. About half of what I did. I also had a bunch of other clients. Actually some pretty big name clients from the San Francisco Bay Area that were Price Waterhouse clients that I got to work on, which was kind of fun. But anyways, there's some pretty cool stuff I did outside of real estate as well. Some are in the wine business, and you would know the names if I said them. But it was did some winery work as well, which is kind of fun.
And what about that? What about handling the real estate made you specifically want to stay within that niche? Was that something that like you choose, or was that just kind of like, this is where my career progression is, just because of where I was working, where you were working previously?
I think in life, some folks get really, passionate about doing something. The truth is, I was not really sure what I wanted to do. It's long term. I knew I didn't want to be public accounting my whole life, because I was a bit too entrepreneurial. I loved to be an entrepreneur. And I want to do something more than just the public accounting side. So I wanted those fundamental skills to go in different directions. I could have gone the tech route. I lived in San Francisco, and had tech. I also had a double major in programming in college as well. So I had a double major in accounting and in programming. But I ended up going the accounting route, which sounds kind of boring in comparison, but it's been very fruitful for me. But once I got into it, and once I really understood it, when you're young, you don't necessarily understand what an industry is and what's it like to be in it. And once I got exposed to it and had knowledge of the real estate industry and how it worked and how it operates, I didn't want to leave it. And as a CPA kind of person, you have the ability to move to other industries pretty easily. And I had no desire to leave it. It's been a great career, and just it's a great industry where you can have balanced life, stuff like family and kids and recreation and working out and all those things in life, and doing real estate investing both. It's easy to have a more of a balanced lifestyle.
So you saw what all of these, all of your clients were doing in their portfolios, and you were helping them to be able to save and make strategic moves. Did you end up taking that information and, trying to utilize that yourself? Or did you say like, hey, that's what those guys are doing, I'm just going to, kind of do my job and, stay behind the scenes?
Well, in my case, I came back from the San Francisco office, the Milwaukee office, and had MLG as my client. So they kind of recruited me away from Price Waterhouse. And again, I always wanted an entrepreneurial situation. So they gave me a minor partnership position and the role as the CFO to join them. And I bought the L out in MLG back in 1991, and the M out in the year 2000. But they gave me an opportunity, and they gave me an opportunity to go be an entrepreneur and to do more than just public accounting work, and really get into the operational side of owning and buying and investing in private real estate. So I got to blend my business skills and really learn and get my hands dirty in all the elements of private real estate.
So this was MLG was a client that you were helping them in their portfolio. How big were they at that time?
Oh, small shop. At the time, there was probably maybe 9-10 people with the firm when I joined them. We're pushing 500 today. And so it was a smaller organization. It was a blue sky opportunity. It was like the guys were doing some good stuff. I got a bit of a funny story. When I came back from San Francisco, and I had some pretty interesting big name clients as well out there. But I came back to Milwaukee, and my very first client meeting was MLG. And I came over, and there's a gentleman named Mike Zimmer and Pat Lesage, but they slid across the table. This is the first year return of 1987. It was in fall of '88, and they handed across the table 12 checkbooks. There was no general ledger. There was no electronics. They had nothing built. And here I'm Price Waterhouse, and Price Waterhouse guys are pretty expensive as far as what your billing rates were per hour. And they had a tax return due in 3 weeks, and they had no general ledger to actually do the financials. So they were pretty green and raw real estate guys doing real estate deals, but they weren't that organized from a financial perspective. So it's kind of funny that I took the job because it was they were not that sophisticated at the time. So it was fun to get in there and do that, but it was a crazy way to get the relationship overall. Start with a shoebox.
What made you want to leave? Because you said you were at a pretty prestigious place before, and then there's these guys that literally they're coming to you with blank ledgers and they're saying, hey, Tim, help us, and then you end up wanting to work for them. Like why did you do that? How did that come about?
Well, they had some cool real estate projects they're working on. I could see how they were making money and what they're doing. I was 27 years old, and I got the opportunity to be a minor partner and have an ownership stake and stuff. As a young adult, the opportunity to be part of the game and grow my own opportunity and have a piece of the pie, that was very intriguing as a young adult.
And this position, were you going in there? Like, is this a common thing for CPAs that are working with real estate clients to eventually get added on, like just recruited, or is that not?
It happens. It happens really in all industries. Where the guy is working on a particular client, because they get to know the business, right? You spend time with them, you get to know the business, you get to know the financials. And so there's a bit of a comfort level that you get with somebody. And it's common that the CPAs are recruited away, especially from the public accounting firms that get recruited away to join clients, and then they get to be more entrepreneurial and more part of the business operations and not just the financial, reporting aspects of running a business.
So you said at the time, this is back in '89, MLG only had about 10 or so people. What was it like back then when you first joined, and where were they as far as like their portfolio and how they were trying to grow?
A couple of partners had some multifamily experience. A couple of guys had some commercial experience. There was really three guys that were partners at the time. And one of the partners spent his time in Dallas, Texas. And so they had maybe 800 apartment units, something like that, managing maybe 1,000 units total. And today we're close to 20,000 units that we're managing and overseeing. So it was a relatively small shop, very entrepreneurial. Get your hands dirty, and you come from a big accounting firm. You have all these support services. You come into small business. There's not a lot of support. I mean, you do whatever it takes. I mean, we had a real estate project. I remember being out there on the weekends, and we're cleaning up garbage on the site. That's not in the CFO's role job description, but the reality when you get small business, you do what it takes to get the job done, and whatever has to be done, it's got to get done, and somebody's got to do it.
So what did they, what was your position when you went there? Like, was it like a blank slate, like that ledger, and it was just like, Tim, we need you, but we don't really know where we need you or how you can do this? And did you have to kind of create your own roles in that company?
Actually, that's exactly what happened to me, because there wasn't a real strong financial structure here. And so just building all the financial systems and building structure around that. And then also when you were buying stuff, a lot of stuff literally was on the back of a napkin. It's like the old boys way of doing it. And back of the napkin, yeah, this is a good price to pay for this, and adding, the modeling and all the things you can do with Excel spreadsheets and creativity you can use in kind of predicting the future through using spreadsheets, and just bringing that into the organization was beneficial to them. It's beneficial to me. I got the opportunity to be hands-on in real estate operations, and they got the benefit of my financial skills, into the mix.
So being the CFO, were you doing like any of the underwriting for the properties, or were you just strictly, there to be able to help them, make sure that
I did almost all of the underwriting, on the deals. So I was doing underwriting on the deals and modeling on the deals, and helping also organize and raise capital from folks and talking about the opportunities with people. So a lot of front face client time raising capital for the deals that we were putting under contract. One of my other partners did more of the chase, working with the brokers. But once we got something close, then I was very much involved in all the due diligence and underwriting and raising a capital and getting the debt organized. Really, the whole aspect of debt and equity.
Was that something that you learned at your previous job, or was this completely new to you?
It was all no, just thrown into it. Go do it. We need to go do this. We need to go raise millions of dollars for this deal. Put together the information to go present it to people, and we did it. We just went and did it.
How natural did that come to you? Was it because of your experience as a CPA that you felt comfortable doing this, or was it like you had to have your partners be able to really kind of show you the ropes on how this would be done, or was it vice versa?
I think we all brought different skills to the table. Everybody had different elements of skills they brought to the table. I actually enjoy the selling process, even though I'm a CPA by trade. I enjoy communicating the story and sharing why we want to buy something. So there wasn't a lot of training. It was just go. It was just here. Who can we meet with, and let's go present the opportunity and go raise the capital for the deal.
What was your biggest struggle when you first joined MLG?
I think you come from an organization that's got a lot of support services and everything you can imagine in our large national accounting firm to, a smaller shop where you just don't have as many support services. There's also, you just have to go figure stuff out. So it's the challenge. Sometimes you get this assignment and go, I have no idea what to do with this, and you just have to go figure it out. And we didn't have Google back then. It took a lot more effort to figure stuff out. We didn't have the benefit of Google to figure out what we should be doing in certain circumstances.
Was at the time, was MLG raising capital as a fund structure or through syndications?
We did all individual syndications really through about 2010, and then really launched the fund concepts in 2012.
So you said that during that initial time that you were also the one raising capital alongside them?
Yeah.
So
I was probably raising about 50% of the capital for all of our deals.
50% of the capital? Where are you pulling this out of, Tim? Like, did you have like a bunch of was it from your previous clients, or like how did you even know how to be able to do that?
Well, part of it, I had the benefit of business relationships. Actually, I told the partners I need to get a golf club membership, and so I'm an avid golfer, and I said, "You put me in the country club, I'll find money." And so you have to put yourself in the position. The truth is, you have to believe in what you're doing. If I didn't believe in what we're doing and I didn't have confidence in what we're doing, I wouldn't tell people about it, right? I'm not going to take money into something I don't personally believe in. So, the truth is, I open up every element of relationship I have, relationships from church, kids' school, country club, athletics, whatever. You don't raise capital you can raise people from capital people you don't know. But the truth is, when you're a smaller company and you're trying to get going, most of the capital doesn't come from somebody you know. I also had people from my Price Waterhouse days that knew me in that role and knew my skill set, in the financial world. So that helps. I'd say most of my capital came from either Price Waterhouse relationships or from, again, like I said, personal stuff like playing golf, kids sport activities, church activities, neighborhoods. You have to really be willing to open up your relationships as a smaller, newer company. You have to be willing to open up relationships to get capital in the door. Today people have the benefit of crowdfunding and putting stuff on the internet. We didn't have that. It was get on the phone, call who you know, tell them the story, get excited about it, believe in it, and go tell the story.
A lot of people listen to podcasts or read books because they're trying to figure out how to be able to do this. Did you have the benefit of like your partners really kind of showing you what it is, or were you trying to just figure this out all on your own?
It was really just, you get out your, I say Rolodex. I don't know if people ever know what Rolodex is, but you have to look at all your relationships and you have to be willing to pick up the phone and call them, that is, again, you have to be willing to pick up the phone and ask people. The money just doesn't walk in the door. Again, now we do have the benefit of crowdfunding today. You can put stuff out there, but certainly in my day early on in the real estate world, it was all about being willing to pick up the phone and call people But, the call and say, hey, give me your money that you worked hard to earn and trust me that I'm going to do a good job with it. You got to feel good about that. And, the good news is, we never lost since, 2009 was my first losses ever on a deal. I never lost money in a real estate deal in my career until 2009. That first couple of losses ever. But I never lost money in a deal, and so when you have a track record, that helps. Then we have a track record to sell and tell. Early on, you don't have that track record, right? We're a newer company and you just got to go make it happen. But over time, you start having a track record and you can show that you're good and you're disciplined and you do real underwriting and do real assumptions that are believable and achievable. That's my big mantra. Today I still say the same words. You got to do smart real estate deals and you got to do assumptions that are believable and achievable. And if you do that, things will work out.
So when you joined MLG, you were put in this position as a CFO, but it really sounded like you were kind of, just like everybody else, you were going out there, you were underwriting, you were pitching investors, you were really just growing as everybody else. What was that next big obstacle for MLG?
Big picture, we did a blend of a couple of things. And we had a commercial brokerage company, third-party management company. We built, we did over 7,000 acres of land development, and like 70 projects. we had a lot of investment deals, buying commercial assets, retail, office, industrial, multifamily. So we had our hands spread wide. And, one of the biggest lessons I learned, and painful one a little bit to a degree, was in 2009. You can start to believe that you're so good that you're never going to make a mistake, or, that you're invincible. Land investments, frankly, they don't produce cash, right? And development deals don't produce cash until you have tenants paying rent. So, the development risk, is real, and you have to ask yourself when you do development, can you afford to take that risk? Is it worth it? And we shut down our development group in 2010, and roughly 35, 40 people were let go. And we said, we're just not going to do development anymore, because I don't want to take that risk of putting money into the ground and the market falls out and you have the pain and fall out of that. And so I said, we just invest fully in cash flowing deals, existing deals that we can reposition and enhance and grow the revenues. And I just stay away from development deals just because it's just not worth it to me personally to take that risk anymore in life.
So between 89 to 2009, everything was going pretty well for you guys. You just can you walk us through like what was that time frame? Like you jump in, things are a little bit messy, but then what did you just like find your rhythm? Like how did that go up until that 2009 point?
No, it was all good. We were buying multifamily. We did a lot of multifamily, a lot of industrial. We did 35 different industrial projects, encompassing like 3,000 acres of industrial land. So we did quite a bit in industrial space. And then we did some office and some retail. So we did a mix of things, and were there deals that struggled? Of course, there's a couple deals that struggled. We had one. Our worst deal ever is a deal we broke even on, but we only owned it for a year. We bought a deal. We thought we had a tenant in our pocket, and the tenant went away. So we sold the deal for what we paid for it. And then my second worst deal ever would end up being like a 6% yield deal. But most of our deals, they produce that 14, 15, 16, 17, 18% or higher kind of IRRs, year after year. And so you get to think like you're pretty good and pretty invincible. But stuff happens. And so, that the development deals, going through a cycle of deep dive was 2008, 9, and maybe you could say we should have saw it coming. But didn't necessarily expect to see it as deep as it was. And just understanding that stuff happens, makes you relook at how should you structure your business. And the biggest thing I've done is creating diversification for people. My clients, I had a client that actually 2012 was asking to reinvest with us in a deal, and they lost money in this one deal we lost money on. And his wife's like, "Hey, why are you going to do this deal with these MLG guys? We just lost money in this last deal." He said, "Hey, Tim, put together a schedule for me of all the deals that I've ever done with you." He'd done like 20 different deals with us, but we'd more than doubled his putting the lost deal into the bucket. We had more than doubled his equity consistently with about an average hold of about 6 years' time. So then it gave me thinking, I just didn't get people investing in a basket of assets. I didn't want to sit across the table ever again and look somebody in the eye and say, hey, we lost money in this deal. So going to a fund structure where you got diversification, and you're forcing your clients to have diversification, so they're not necessarily picking the deal. And I had what's proverbial, the deal that we lost money on. There's a retail shopping center deal that our bank went out of business. It wasn't even our fault. We never missed a loan payment ever. We had a loan maturity in November 2009. Our bank goes out of business. The FDIC takes the bank loans, it's $1 billion in real estate loans, and sells it to a vulture group. Vulture group says, "Hey, your loans matured in November 2009. And they say, write the check or give us the asset. And they had the legal right to do that. But when you're borrowing money from the bank, you think that as long as you're making your payments, they're going to extend you again, right? You don't expect them to say, write the check. Well, November 2009, the stock market was down to 6,000 or 7,000. The Dow was, and there was no loan to get anywhere. And so we had to give them the keys on an asset, on a deal that we'd never missed a loan payment on, other than the maturity payment. And that was crazy. I mean, you felt really unjustly treated. It just didn't seem right. But that's what happened. From that point on, getting people diversified. But I did have a couple clients that were brand new clients. That was the only deal they'd ever done with us. So unlike the guy that invested in 20 deals with us, they'd done that one deal, and that one deal turned out to be a horrible experience for them. And I felt horrible, and I said, I'm just not going to put myself in that position again or another client. So that's why we do the fund structures, so that people get diversified and not have that single asset risk.
So that was the real tipping point for you. That was like the last syndication that the bank ended up pulling out, and you said, hey, we can't risk this again.
Yeah, remember the bank went out of business, so the bank didn't pull out. The bank got kicked out, and the FDIC took their loans and sold it to a bunch of bad guys. But that was a tipping point. It was a tipping point to say, hey, we got to find a better way to do our business, and we got to find a better way to structure our business for our investment clients, for them and for us. There's a better way, and we think we found that better way. So out of every challenge in life, there's a blessing, right? There's opportunities that come from challenges, and I know our company is 10x what it was because of going through the challenges of 2008-9 cycle.
Where was MLG at this time in the 2008-9 period?
We operations in Florida, Texas, and Wisconsin. Probably maybe about 180 employees at the time. Managing probably 6 million square feet of commercial assets, kind of thing.
Wow. And you became the CEO of MLG back in 2000. What was that something that you were prepared for, or that you kind of knew was already happening, or what was the reareasoning behind, where did the partners leave, or was it just like, hey, Tim's got this on
long-term succession planning? My fellow partners and we still own assets together. We have great relationships, and it was just time to do long-term planning. And what was going to happen is, the guys there were maybe 25 years older than myself, and you get to a point where, okay, well, what's this going to look like for everybody? And so you work out fair, and that's what partners do. They work things out fairly with one another, and you work it through. And it was I just know it was a role I wanted, and sometimes in life you got to go get stuff, you got to go make it happen. I've always, in smaller companies, I've always said that power is taken, not necessarily given. You got to go. If you go and you make yourself that valuable to the company and you do that great a job, effectively you're taking the power, not in a negative way. It's in a positive way because of your performance. You got to go make it happen in a company.
Did you feel like this was that this was your company, not that you were just getting hired onto another position, or just getting a promotion? Did you feel like this was just kind of like your own company?
Well, it's kind of progression. When you first come on in 1989, you feel like you're an employee, right? You're just joining the company. But over time, you ingrain yourself and become more critical to the business, and you feel like you're one of the partners, that you're fully ingrained. And today, my belief is to have a lot of your key guys in ownership. So we have like 14, 15 people that share in the ownership and profits of the company. It's just been my philosophy always, and the guys before me had the same philosophy. And so I just bring people in, and if they're valuable and a great job, they get to play in the game.
From that time that you joined to the time in around 2009, you said you had around 180 employees. Were you really kind of the key instrument for that massive progression for MLG during that time, or was that other factors?
There's many. It's all about talented people. You can't grow an organization without talented people. So we had many people contributing to that. There's a core group, obviously, that drive that. It's probably let's call it 7 to 8 people that really drive it. But you have to have that core talent. You can't do it by yourself. You can't. It wasn't just me. It was a broader team that made it happen. Obviously, I was critical to the process, but it's definitely a broader team that made it happen.
And up until that 2009 point, you were doing all just syndications during that.
Correct.
Why didn't you switch to a fund model earlier? What kept you going doing syndications for so long?
That's a great question. I wish I would have done it sooner. I wish I would have done it sooner. The people, frankly, anybody who invested over a 10-year period of time, that included the 2008-9, if they invested in multiple deals with us, they made good money still, right? And they never would have felt the pain on the one deal that didn't do so well. So I wish I would have done it a lot sooner overall. But, sometimes in life, and, we never lost money before. We made money in every deal. So it's like you don't think you need to do a fund when you're making money in every deal, right? So you think you're good and you think you're infallible and you feel you can't get beat. But external forces, cause that. I don't, even that one deal that we gave back to the lender because the bank went out of business and the Vulture Group bought the bank loan. That deal, I bet we would have worked our way through that deal, and I don't think we would have lost money in that deal. But we ended up losing it because of things beyond our control. It wasn't our execution risk; it was our bank went out of business, and our bank got FDIC sold the loan to some guys that aren't very honorable folks in my book, but it's what it was, right? And so you learn from that. And what are you going to learn from that? And we all go through trials in life, and mistakes are made. The question is, what are you going to learn from that, and how are you going to do things different? And so we made some material changes. One was fun. We also made another material change to how we source our opportunities. We used to just do direct deals on our own 100%. But one of the challenges I've reflected on, challenges that we have in our industry, one is, how do you source the best real estate opportunities? And we added what I would describe as a JV equity strategy within our company, and that we proactively will invest with other real estate guys around the country. So in addition to doing our own direct real estate deals, we have a JV equity program that we identify real estate guys all over the country, and we'll say, hey, we'll invest in your deals. And I respect other people's skills and talents and relationships. The best deals come from relationships that you have. And I can't match a guy in Minneapolis who's been there for 30 years and the relationships that he has, or somebody out in Albuquerque, or somebody down in Nashville, or somebody out in Denver. I can't match somebody who's been there for 30 years doing business. And so we said, rather than trying to open up a new office in Denver or a new office in Minneapolis or whatever, as we wanted to expand our geography, we said, we're just going to invest in other real estate guys. So we wanted to expand our geography so we had more opportunities. But rather than opening up multiple MLG offices around the country, we said, we're just going to invest proactively with other real estate sponsors. So we're this vertically integrated real estate company. We manage roughly 20,000 apartments. We got millions of square feet of commercial assets, about 6 million of commercial assets. But yet, we're shoveling snow, fixing toilets, but we also, invest with, real estate sponsor based in Denver or Minneapolis. And we're doing, about half what we do now is the other guys' deals. They're not our deals. And so that JV equity strategy, in addition to our 30 years of relationships in our markets of Wisconsin, Texas, and Florida, we get the benefit of their relationships and our relationships. So our model is so much stronger because of that diversity of our deal flow from all those real estate sponsors. And we see about 60 deals a month from other sponsors around the country. And we're looking to invest in one or two of those. So much more of a critical selection process in addition to our traditional direct sourcing strategies. So it's through pain, there's great changes and great opportunities that come from it.
And speaking of that pain, when you first started MLG, or when you first jumped into MLG, you had around 10 people, and these 10 people were basically doing what you were doing at a smaller scale, what you were doing at 180. What was it completely different, or what, like, how does scaling up your people, how did that really change the dynamic of your company, or was it essentially really kind of the same thing even at a larger scale?
Well, you have to we're up to roughly 500 people now, and you have to build corporate organizational structure, and you have to have people that are in charge of stuff, and you got to give people enough authority to run and go and do the thing. You want to hire talented people, give them coaching, create accountability structures, but then let them go and let them run with what they're good at. So again, it's a bit of divide and conquer, learning how to delegate that was a challenge. I guess you talk about challenges. I mean, learning how to delegate, that took me some time to learn how to do that and let other people own stuff and run stuff, and not be too much in their business of day-to-day activities. So it takes time to learn that, and that was definitely a skill that you learned over the years. But I probably wasn't so good at it early on as far as learning how to delegate. But got much better at it over the years.
When do you feel like there was a real turning point as far as like what you were doing in the job? Because when you first jumped in, you were kind of, you're the jack of all trades, you're doing everything. At what point was it like, hey, I got to step back and now I'm putting people in place that are able to replace me, and when did that shift really happen for you?
Well, I really, ever since I became the CEO in the year 2000, I've been saying I need to work myself out of my job. So that everything I was doing day-to-day operations, I wanted to have somebody that was doing that so that I could focus on strategy and just being a coach. So my goal was to have somebody doing every element of operational sales, marketing, whatever I did for the company. I wanted somebody else to do it. And so then I can just be on the side, helping coach, train, strategize, new opportunities, new initiatives, and not have time spent on the day-to-day blocking of real estate. So getting out of asset management, getting out of financing, get out of fundraising, get out of the deal chase, all the elements of the business, having a team built around to do every element was critical.
So you really had to learn all the ins and outs, how to build the team. So by that point, you were, would you say that like your partners were kind of, it was just kind of you at that point? Like were your partners still there helping guide you on like how to be able to scale this? Or at this point, you already kind of had everything figured out and you're putting the systems in place?
The whole management team and partner team, we worked I'm a consensus builder. And so we all worked. It wasn't just me. I mean, everybody was contributing, had ideas on how to structure it. Even today, some of my younger guys are, making suggestions on how we could make this better in one section, or do that, do this. And I love it. I love it when guys are coming up with new ways of doing it, or we should tweak how we do this element of our business and redo it in a different way. And I'm all for change that brings more productivity or more joy to how people spend their day. And I love it. The truth is, I'm not necessarily the best organizational guy. I actually, I like doing everything I said I want to hire somebody to do. I actually enjoy chasing deals. I enjoy getting the debt structure. I enjoy structuring the deal. I enjoy all those elements of what we do. But by having somebody hired to do all that stuff, it frees me up to come into the situation where the things are most critical. So if the deal needs to be structured and it's critical how it gets structured, I can come and help that specific opportunity. And so I can pop around to where my skills are needed. And the other partners too. The other partners, have all the varieties of great skills and they add great value. And, again, it's building a team concept. I also refer to MLG family or MLG team. You hear that a lot around the office, and try to build a consensus type environment where we are all striving to make this thing work better overall. So it doesn't happen by one person. It just doesn't. It's a big team making it happen.
And what was that experience like? So 2009, when you had that deal that didn't turn out the way that you wanted it to, you decided to switch to a fund model. What was that like for your company? You have 180 people in your company at this point. You're doing syndications for all these years, and now it's like, okay, we're gonna, was it a big pivot for your business? Like, what was that time period like?
It was a big pivot because we said we're going to get out of the development business, so we dropped from 180 down to maybe 130 people. So a big pivot there, and then you have to create the legal structure and you got to do it right. And so we had to create the legal structure and set the strategy. So remember, we added the JV equity strategy at the same time. So we're building out the sales team to go do the JV equity strategy. We're investing with other sponsors. Initially I was on the road with the team, talking to other sponsors around the country about their deals. And over time I stopped doing that, but I want to understand what it was like to go do that. So I did it with the team, initially. So you cast a vision and you figure out what has to happen in that vision. and you build your team with that. So, there's some changeover in talent and redeployment of payroll dollars for other types of positions because there was some serious change, and that stuff's hard. I mean, I am the slowest guy in the world to get rid of somebody. It's just not me. And I've been accused of keeping people too long if they're not doing a good enough job. And I try really hard to give people a chance, but so making changes and is not necessarily my skill set. But you got to do it because it was needed. It had to be done.
What is that? What is that like when, I mean, you have this machine that's really rolling? I imagine it's got to be very challenging to, just kind of take a moving vehicle and then, basically try to change lanes almost, still, it was probably still similar, but what was that experience like?
A lot of long days, a lot of hard work, honestly. I mean, I would, when we were making the change, I mean, I'd be up at 5, 6 in the morning, taking notes, strategizing on the day, strategizing on, what needs to get done. Because when you're doing something new, and plus I also, a lot of the stuff, we would create this new vision, new strategy, I wanted to go live it. And so I was doing a lot of the execution strategy with the team. So I wanted to really feel it, and be able to adapt to what it was like to be on the road doing what we were doing. So, there was just a lot of hard work, just a lot of early mornings, a lot of late nights, just working hard. Good Midwest boys and gals work ethic,
What's the big difference for those individual syndications to when you switch to a fund? Was the returns or how that paid out to investors differ pretty significantly, or did that also maybe change how you got paid as a company differently? Like, what was that whole period like?
Actually, the deal got better for the investors because, when you do an individual syndication, a real estate guy gets this promoters, your share of profits above some benchmark yield. Like we give investors, investors get 8% on their capital first. They get 100% of the cash flow. So they get 8%, and then they get 70% of the upside, and we get 30% of the upside. So when you do individual syndications, the real estate guy makes 30% on every deal that does well. But in a fund structure, if you have some deals that lose some money or don't do so well, the good deals have to pay for that. But in individual syndications, if in that structure, if we had a deal that didn't make money, it didn't cost me much as a real estate other than my pride and somebody else's money and reputation kind of thing, which is material in its own rights. But economically, it's better for the investor because now the real estate guy is accountable for his mistakes, and his mistakes have to be paid for by the successful deals, and then it reduces their share of profits on the successful deals overall. So that's a material difference, and it's much better for the investor. We certainly give something up in that, overall.
And how big of an impact, just like operationally? Because if you're doing a bunch of syndications, that's like probably doing a bunch of single flips almost, and you were doing those all over the country, and you probably had a really good system in place. But what was that like when you said, like, hey, we're not going to get all of these individual investors involved in every single deal, and we're going to switch to, people are just kind of pooling into one? How did that impact your business?
Well, I mean, ultimately, I think it's beneficial for us on the Chase side, because if I have, a current fund, 250 million, and I have, 20 million ready to invest, I can confidently go and make an offer and say, hey, listen, I'll do this deal. I'll do my due diligence in 30 days and I'll close in 45. I get a lot of confidence in that. But when you do individual syndications and you don't have your capital organized yet, you sometimes you have to, well, I don't know if I can do this deal in 45. I think I might have to ask for 75 days. And then maybe you lose the deal because the guy next door to you says he can do the deal in 45 days, right? And so that the ability to be able to be more aggressive on speed and time is a valuable element and advantage that we have over somebody that's doing individual syndications.
Do you think that that the model that you had going for so long, growing and scaling the syndication model, that is a very sustainable thing? Do you think that you could have very easily kept going, or do you think that you really just kind of were doing something for a little bit too long than you should have?
Well, I mean, there's nothing wrong with the individual syndication model. It's actually better for the real estate guy than it is for the investor. And from a real estate guy's perspective, there's nothing wrong in individual syndications, especially with crowdfunding today. I mean, if your deal makes any sense at all, you should have no problem raising the money on the internet. And so, in many regards, it's much easier to raise capital today than it was, when we were doing it for all those years. Um, but ultimately, if you have a track record, and back in my day, it was all about your track record. If you had a great track record and you're consistent, it was never a problem raising money. So I never had a problem raising money for a deal. It was all about getting deals that made sense. That was the hard thing. Finding the money really wasn't that hard. Once you built your reputation and you've performed for people, it was not hard to get money. It was just hard to find great deals. And that's also why we had a JV equity strategy as well.
And is the JV equity strategy just for specifically for the fund model, or could you have been doing that as a syndicator?
It's really for the fund model. Not getting into technical legal stuff here, but if you need a securities license to be raising money for other guys' deals, and that's not our model. So it only really works in the context of our fund structure.
Okay. What do you feel was the biggest mistake that you've made during the time of really growing MLG?
Not doing the funds earlier in my career. I wish I'd have done the funds much earlier in my career. And also fully understanding the risk of development. And again, you can get blinded by your success and you think you're so good and the unexpected happens. You can get blinded by your own success. And we had many projects that were successful. And then all of a sudden we had 2008-9, and it didn't matter if you're good at what you did, everything bottom fell out. Right. And so that part was humbling, but again, learned a lot from it.
From that 2009, when you did switch to the fund, what was the next kind of the big instrumental pivot or instrumental move that happened up until now?
It was definitely the JV equity strategy, investing with other real estate sponsors around the country. And that's been very powerful for our investors, because now we build a portfolio of maybe 30, 35 deals in a fund, and maybe half of them are sourced from MLG's traditional relationships, and the other half from these sponsors around the country. And it's been good for the sponsors. It's been good for the investors, because the investors get now a basket of 35 deals that we believe are 35 great deals to do. And the sponsor, a lot of times the deals are too big for the crowdfunding, and a lot of them it might be a $20 million check or something like that, which is a little more difficult to do in crowdfunding world. And so by being a check, we're willing to write a check for $15 million on a deal or $20 million on a deal, and that's makes it easier for the sponsor. And again, that sponsor, do they have confidence that they can raise the money when they're writing these offers or organizing a deal? And having a partner like us, because we commit to the sponsor during their due diligence period. Most institutional capital they'll give you a verbal, but you won't get written commitments until like a week before closing. And so you're hanging out there as a real estate guy. So it's been valuable to the real estate guy as well as to our investor clients.
So you would be classified as institutional capital?
We operate in our documents. Look like institutional capital. The check sizes we can write look like institutional capital, but we still operate very much like local guys from Wisconsin, and easy to work with, good partners. We're used to being partners. I've done like 80 or 90 partnerships in my career with other real estate folks. So I'm very partnership oriented as an individual. Again, I think that does differentiate us, because we're relationship based. I think some of the East Coast money on the East Coast, West Coast is maybe transactional in nature versus relationship in nature. And there are certainly guys in the coast that are relationship in nature, but many are transactional.
So what do you look for when because really it sounds like the tables really turned. You went from being the guys that were going out and doing the deals to now you're the guys that are supporting the guys that are doing the deals. So what do you look for when someone is approaching you, or when they have a deal that would you'd be able to create that partnership relationship?
Well, I mean, first, are they responsible on their underwriting? I mean, because anybody can make a deal look great on paper, and the question is, are the assumptions that you're making supportable? Are they believable? And are they numbers that you can truly achieve with reasonable confidence, and not just some dream that you might actually achieve them? So responsible underwriting, good due diligence, do the proper due diligence, verifying. You make assumptions, but then you got to go verify, are those assumptions really real, by doing your down and dirty research in a local market, because ultimately it's a local business. So you got to do that local research and analyzing the deal and assumptions being made. So, but good people. You want people ultimately you can shake their hand, that you don't worry about the paper. That you have to paper up your transactions and look at all the bad stuff that can happen in life and legal documents. The reality is, you want to look somebody in the eye and say, "Hey, I trust you. I believe in you." And go get it, go make it happen. You got a great deal here, you got a great story, you got a great strategy, go make it happen. And so you need work ethic and follow through on that. But it starts with good underwriting and then great follow through and talented people to go do the job.
Do you only work with certain people, or are people that have like a previous history, or would you work with guys that don't, maybe this is their first deal and they know it's a good deal, it's just they don't have the capital maybe to be able to
no, we actually will deal with it. We have our client relationship. We got some guys that are newer, younger in the business, and we got some guys that are 40 years in the business. We got quite a mix. If a group's a little weaker on the depth and the bench, or they're smaller shop and they don't have much talent, frankly, we have a lot of talent here that we can supplement. So we had one deal where the company didn't have the great financial reporting skills inside the shop. They're good real estate guys. And so for that particular year, we retained 100% of the treasury controller function of all the reporting and financial management, and let them focus on the real estate deal side of it. Anyway, so, again, we did, if there's a shortfall, generally we have the talent inside our shop to supplement.
What do you see as the biggest mistake that real estate investors are making when they approach you with a deal?
I think the one is leverage. One of the things I didn't really mention this yet. We used to use 70, 75, 80% leverage like everybody else. And we backed that down to 60, 65%. And that proved out very valuable here in the whole COVID situation. When you bring your leverage down to 60, 65%, you can withstand major disruption and cash flow issues if you have lower leverage. So, being youthful and confident that the things are going to work great, and max leverage, because maybe the debt's cheaper than equity, right? So if they can get as much debt as possible because it's cheaper, that's great. But stuff happens, and nobody expected COVID-19 to show up, right? But if you were highly levered and you had an asset that was impacted by COVID, you're in trouble quickly and unexpectedly. But lower leverage helps you manage through that cycle. Overall, so leverage. Other mistake, real estate guys, just too aggressive assumptions. I had, and sometimes it works out. And we had some deals in Atlanta early on, maybe 2013, 14, that we looked at, and they were assuming 6% rent growth, but they weren't doing anything to the asset to improve it. So if you're doing nothing, then we can't justify using more than inflation type numbers, which might be 2 or 3%. Inflation type numbers, but they're assuming 6% rent growth. Now, they ultimately turned out to be right. The rent growths were 6% or more, but I view that as more getting lucky than being right. And maybe they had a crystal ball that told them that. But assumptions that are really achievable. Even like right now, you're on an underwriting deal today. Are your assumptions taking into account COVID-19? Yes or no? And if you're not assuming any impact from COVID, you might be dreaming a little bit about that. So again, that believable assumption thing and doing reasonable assumptions is very important in setting up your financial structure.
Tim, thank you for taking so much time out of your day to be able to share with us. One last question that I really love asking is, what's a question that you would have for someone that is in a similar place than you, or maybe that next step where you're trying to take MLG in your company? What question would you have for them?
I'd say, one, are you taking care of your people? Are you taking care of your talent? I think a lot of people think in today's world, go work here for 3-4 years and go work there for 3-4 years and bounce around. In real estate, I don't think that's wealth building. I could see making a move, if you're not getting the opportunity you deserve for the value you're bringing, I can see making a move as an individual employee. So take that back to the guy that's a real estate guy like myself. Are you doing the things to keep your talent inside your shop? Yes or no? That would be my biggest challenge to real estate guys is, are you taking care of people that you need to take care of so that they're not enticed away to someplace or some other firm.
And you see that being a big struggle when you're at the size that you are, that people are getting pulled away from your company, that valuable talent?
Well, you can be, right? Because, you train people well and they become valuable in the industry. And so we have to, we have to take care of the key guys, otherwise they can be enticed away. And so that's my job as a leader, to create structures that allow that to happen.
And where do you see MLG going from here? Or do you feel that the business is still fresh, that there's still a lot of room for growth, or do you think that you guys have reached it?
There's a ton ahead of us. We've really positioned MLG to be an outsourced manager for registered investment advisors, money manager kind of guys all over the country. And a lot of money managers want to get into alternative investments outside of stocks and bonds, get away from the volatility of the stock market. And we're providing a product that's tax advantaged, it's an inflation hedge. And you're just at the front end of that. I mean, if you look at the Harvard Foundation, they believe that 40% of investments should be in alternative investments, which includes real estate, private equity. And the stock market is nice. It's great for liquidity, but the volatility is substantial, as we've seen in the last 6 months. And, private real estate just doesn't have that volatility. It's got a very low correlation rate to the public markets. So I think we're at the very front end of this. We're trying to make private real estate investing a very sophisticated, easy way to invest in private real estate. It's hard for money management guys to do the individual syndications on the web crowdfunding. I mean, they don't necessarily have the time and experience to go look at all these deals and figure out which ones are good deals or bad deals. And so we're providing that service to our clients, and trying to be that manager for money managers all over the country and get into private real estate. So big things ahead. We also have some great wealth transfer products. People that have made a lot of money in real estate and they're dealing with wealth transfer issues as they age up. We have some products that are specifically for that. Again, unique to the industry and very valuable for folks that have made a lot of money in real estate and want to now kick back and enjoy life and want to have a good strategy how that wealth is transferred to their next generation. So those are our two big growth areas.
So it sounds like, that growth phase was that syndication to where now you're helping to fund other people's deals, and now you're actually providing alternative services within your fund structure.
Yeah, and broadening our target audience and deepening our reach into the real estate industry by partnering with local real estate guys, by helping wealthy families that have made a lot of money in real estate, and they're dealing with how they're going to get this put into this portfolio for the next generation. Are the kids going to stay in the business or not? Trying to be a service provider to them, and also again just making private real estate a great spot to invest outside of stocks and bonds and gold. I mean, real estate's a great inflation hedge, better than gold because it creates current income. Why you wait for inflation to happen? But when inflation happens, our rents are going to go up, and the value of the rents, but we're making money while we wait for that to happen. It's much more dynamic. There was a study done by Standard & Poor's that showed that private real estate outperformed gold in every inflation cycle in the last 40 years, 50 years. So, anyways, there's big things ahead, and we're very excited. And I'm very excited for my team because they have a lot of opportunity ahead of them.
Awesome. And what's the best way, if anybody wants to be able to reach out to you, Tim, or they want to find out more about MLG, how can they connect?
Probably best is to go to our website, and it's www.mlgcapital.com. So like Mary, Larry, Gary, mlgcapital.com or mlgcompanies.com will get you there. So
Awesome.
That'd be awesome.
Awesome. Well, thank you so much, Tim, for taking the time. And until next time, deal makers, talk to you later. Hope you all enjoyed this episode. If you did, please go on over to iTunes and leave us a review, as that greatly supports the show. And if you'd like to be able to connect with John, the community, and I, then come and join us on our Facebook group, the Multifamily Success Network, where you can connect and make deals with other multifamily investors. Go to multifsuccess.com/community.